like Kevin said, my name is Jackson Matheson, and in the next 15 minutes or so, I want to change the way that you think about reverse mortgages. We're going to start by playing a game called Raise Your Hand if you want 20 bucks. That's what I thought. All right, put your hands down. I only have one $20 bill to give away. I only got one $20 bill to give away, so I'm going to give this $20 bill to the first person who can show me a $100 bill. Has anybody got a Benjamin in their pocket? Got one? Oh, we got one. All right, come get your money.
$100 Jamaican.
I saw Jay back here.
True story.
Yeah. Well, Jay, come get it. All right. You can come see me afterwards. Seriously, I'm gonna give you 20 bucks. The point of that story, the point of that illustration is to show that there are always opportunities for people who have access to cash. And the question that I asked the rest of the room that didn't have any cash in their pocket is, where's all your money? And the answer for the vast majority of Americans is, we have more money than ever stored in our homes. This is a chart showing the amount of home equity as a nation going back to the 1950s to today. If you look on the right-hand side, we have about $36 trillion of home equity. There's been exponential growth since 2010. And what's even more important than this is half of that equity, about $18 trillion, is owned by one generation, which is the baby boomers. Now, these are national numbers, but what does this look like on an individual family basis? Well, for a typical retiree age 65 to 74, your median retiree net worth is about $400,000. And if you break that money out into their different asset classes, home equity, their retirement accounts, and then just other financial assets, could be business equity, life insurance, something like that, you find that their largest asset class is home equity. It's about 45% of their net worth, almost half. Number two would be their retirement accounts at about 30%. Now, an average retiree has about 4 times that net worth, roughly 1.6 million, but their percentages are almost exactly the same. They just live in bigger houses. And so it's still over 40% in their home and over 30% in their asset class, in their retirement accounts. What about for a high net worth individual? A top 5% retiree is about $6.5 million. Home equity now is their number 2 asset class, but it's still a third of their net worth. And in this case, that's $2 million. That's a lot of money to just be stagnant on your balance sheet doing nothing. So there's a couple things I want you to take away from this. Number one, I already said it, there's a lot of money stored in home equity. Number two, home equity is a significant portion of our total net worth as a country for the vast majority of Americans. And then number three, home equity plus retirement accounts for, again, the vast majority of Americans makes up nearly all of their net worth. So why does that matter? Dr. Barry Sachs is a Harvard-educated tax lawyer, and he's also a huge advocate for reverse mortgages. I think he's in his late 70s, maybe 80. He has a reverse mortgage on his own home, and he says that the mass affluent retiree has the most to gain from a reverse mortgage. And one of the things he says in one of his research papers is that the greater the ratio of the home value to the securities portfolio, think of the chart I just showed you, the home equity versus the retirement accounts, the greater the value of the home value, the greater the ratio of the home value to the securities portfolio, the greater the benefit of strategic coordination between those two assets. We're going to talk about coordination a lot today. Before we go any further, let's answer some basic questions like, what exactly is a reverse mortgage? And for the purpose of this presentation, when I say reverse mortgage, I am talking about a home equity conversion mortgage. That is a specific type of reverse mortgage. It is insured by the Federal Housing Administration, the FHA. It is regulated by HUD. It's a very specific type of reverse mortgage product. It is designed to give a retiree, a homeowner or home buyer over the age of 62, access to a portion of their equity, not all of it, just a portion of their equity, without incurring a monthly principal and interest payment. And I emphasize that part because that is very important when we talk about managing cash flow in retirement. So we want to be able to have liquidity in our home without having a required monthly payment.
Jackson, how long has this product been in the marketplace?
So we'll talk about it later, but it's been revolutionized since the Reverse Mortgage Stabilization Act of 2013. So most of the things I'm talking about today are really in the last 10 years. Reverse mortgages specifically started in the 60s, and a home equity conversion mortgage came around in the 80s. That's the quick answer there. Your home does not need to be paid off entirely in order to use a reverse mortgage. In fact, frequently, people who have the most to gain from a reverse mortgage are those who have not paid off their house over the age of 62. And finally, the FHA insurance that comes with this product provides all kinds of safeguards and protections designed to help the borrowers, the surviving spouse, and then ultimately the estate and the heirs whenever the home is passed on. So the next question is probably like, why aren't more people doing this? And that's a great question. There's a lot of answers to that. Three big ones that I deal with a lot. The first one is horror stories. I don't want to belabor this point, but we've all probably heard, I'm well aware of the idea that reverse mortgages have had a pretty bad reputation going back in the 80s, the 90s, early 2000s. What I'll share with you is that virtually every horror story I've personally heard or read about either happened before the Reverse Mortgage Stabilization Act, or it was some other type of reverse mortgage that was not the FHA insured product, and it was way less regulated. Another one that I hear a lot is, well, I've got a low interest rate. I don't want to refinance out of that. And that's great. I mean, if we're borrowing money, we want to borrow it cheap. However, if you have an interest rate under 4%, what that really means is you got a mortgage payment for another 25 years because you just refinanced during COVID. And so the question is, do you want a low interest rate and a payment for the next 25 years, or do you want to eliminate that required principal and interest payment and have the right actual mortgage vehicle that's designed to complement your retirement plan until you choose to leave the home or until you pass away? Finally, well, Jackson, I don't need a reverse mortgage because my house is already paid off. Again, that's great. I don't think it's ever wrong to pay off debt if you don't have anything else to do with it. And really all that means is just you have a lot of equity and a lot of options, but the question, back to the Barry Sachs chart that I showed you before, how much of your net worth is represented by your primary residence? And is there any benefit to be gained for having access to at least some of that money for some point in the future, even if you don't have an immediate need right now? And again, the answer for the vast majority of Americans is absolutely. There's a benefit somewhere, some way. So now we've got those basic questions out of the way. Let me go to some more high-level strategic thinking. So Larry Fink, CEO of BlackRock, he's a billionaire, he's a smart guy, he knows a lot about money. He said, we spend an enormous amount of energy helping people live longer lives, but virtually no time helping people how to afford those extra years. We're all very blessed to live in a great country, the United States of America. It's awesome that we are living at a time where life expectancy is increasing, and in general, our quality of life is also increasing. But to use an Army term, the implied task there is we need to change the way that we're planning for retirement in order to be able to afford that. Because for the last 50 years, for my parents and certainly for my grandparents, retirement planning, the foundation of retirement was pensions and Social Security. And today, the only people with pensions really are career government employees, and Social Security is not doing so hot, right? Today and moving forward, pensions have become defined contribution plans, most commonly a 401k. Social Security, I don't think is going to go away entirely, but it's going to have to be heavily reformed probably in the next 10 years, and who knows what that's going to look like. The next biggest asset class that is readily available to the masses and being currently completely neglected in retirement planning is housing wealth. And then I also add, there's still insurance planning and estate planning. All those other financial assets don't go away, they still apply. Reverse mortgages is not a competing product with that, it's a complementary product with those things. It's something that you add to what you're already doing, not instead of what you're doing. Because the money is already there. You're already living in your home, you already own it. You've built up this equity over the last 20, 30, 40 years. We just want to have access to it to be able to use it. Jamie Hopkins is a former professor at the American College of Finance. He's a co-creator of the RSP designation. He's an author. He's also a very successful financial advisor. He wrote an article several years ago called Financial Advisors Should Avoid Error by Omission and Consider Reverse Mortgages. And in that article, he said this, in my opinion, not including home equity and reverse mortgages in the financial planning process is the largest failure of the financial services profession at this time. Those are pretty strong words of him calling out his own industry, but if you read his article, there's two primary reasons that he says that. The first reason is the chart I showed you at the very beginning, which is there's simply too much money in home equity to just pretend like it doesn't exist. It's there, it's a significant part of our net worth. We can't just ignore 30, 40, 50% of the balance sheet and say, we're never gonna touch that. The second reason is best summarized by this quote by his colleague, Dr. Wade Pfau, who's a Princeton PhD economist and one of the leading retirement researchers in the country. He says, if a HECM, a home equity conversion mortgage, allows you to have a more affluent retirement or leave a larger legacy net worth to your heirs, the true cost is to not do it. And that is a complete reversal of thinking from the typical, like, well, I don't need a reverse mortgage, so I'm not gonna use it. We wanna shift our thinking to, I have all this money in my house, is there a way for me to gain benefit from this and have a better outcome than if I didn't use it? The answer is yes, which again, for most Americans it is. Then why aren't we doing it? Why aren't we taking advantage of this tool that we are all very proud of, the homes that we live in and how much they're worth and how hard it was to pay them off? Why are we ignoring it? Jamie Hopkins and Wade Pfau are two pretty smart guys, but they're not the only smart guys who think this. Robert Merton, as a Nobel Prize winner, said reverse mortgages are a potential solution to the global financial crisis. David McKnight, best-selling author of The Power of Zero, when you utilize reverse mortgages, you increase the likelihood of a positive outcome in retirement. Tom Hegna is an author, economist, and retirement planning expert. I was skeptical about reverse mortgages, but I discovered that when you combine housing wealth with other retirement assets, a whole new dimension is added to what can be accomplished. Again, we're adding it in conjunction with what we're already doing. Harold Avansky, the Dean of Financial Advisors, the reluctance to consider reverse mortgages in the distribution phase, which is retirement, in the distribution phase, limits the flexibility of distribution strategies. This is another important concept. I'm going to go a little bit deeper here. So I'm going to go back to Wade Pfau. Maintaining higher fixed costs in retirement, like a 30-year fixed mortgage payment, which is what most people are using to pay off their houses, that is a long-term commitment and a high cost, right? Maintaining high fixed costs in retirement increases exposure to sequence of returns risk by requiring a higher withdrawal weight from assets. Again, the requirement piece is key. That's what limits our flexibility in managing cash flow in retirement. I don't have time to go into the nuances of sequence of returns risk. If you're not familiar with that term, either A, ask your financial advisor, but just know that basically I describe it as the evil twin of compound interest. If you don't have a plan for it, it can really wreck your retirement, especially the first 5 to 8 years. Dr. Pfau is a really smart guy, much smarter than me, but I actually think that this quote is incomplete. And so I always add this caveat here because I think it applies more to your typical middle-class Americans. Maintaining higher fixed costs in retirement also increases the likelihood of future financial hardship for the surviving spouse. And I see this all the time. I'm a Christian husband. I would presume a lot of people in the room are Christian husbands. I believe that my duty to provide for my wife financially ends when she dies, not when I die. And so I see this a lot. And so what does that have to do with reverse mortgages? Well, today, 35 to 40% of people, roughly, I think anecdotally it might be higher than that, but just based on the data that I've read, it's a little bit over a third of the country of retirees who are turning 62 have not paid off their house yet. They're still making mortgage payments and they're carrying these high costs into retirement. And what they're doing is they're using their W-2 income or their Social Security income, or they're taking money out of their 401k every month, and they're making a mortgage payment to try and pay off their house. And like I said before, a lot of them are proud of it or happy about the fact that they have a 2.5% or a 3.5% interest rate, but what that really means is they're gonna be 100 before they pay their house off because they got another 25 years to go. And a reverse mortgage just says, we don't have to make that required principal and interest payment anymore. You still can, but now I have the flexibility to divert that cash somewhere else, wherever that may be. Investing into somewhere I'm gonna get a better rate, paying off other debt, having fun, giving it to my kids, or still making my mortgage payment, but now I don't have to contend with this payment now or after I pass away. My wife, my future widow, doesn't have to contend with that payment either. This is the most complicated thing I'm gonna show you today. It's a chart that just shows, this chart is taken out of one of Wade Pfau's research papers a couple years ago. It's an average retiree with $1 million portfolio and a $500,000 house. And he just analyzes 7 different strategies, that same person using 7 different strategies for different uses of home equity or not in retirement over their probability of success over a 40-year retirement, basically from 60 to 100. there's two things that I want to point out on this chart. The first is that the first 10 to 15 years, doesn't matter what you do, you're gonna be fine. You got $1 million in the bank and paid for a house, you're gonna be fine the first 10 to 15. All of the nuance and the accumulation of risk happens in the back half of retirement. That is what we want to insure against or protect ourselves against. And that is the importance of eliminating mortgage payments now before you need to later. The second thing I want to point out is this black line here that did by far the worst. That's the guy who said, I'm not going to use home equity at all. This second line here, the gray dashed line, is the guy that said, I'll use it as a last resort. I don't need it right now, but I'll turn to a reverse mortgage 10 or 15 years down the road if something happens. And the main message here is that proactive people, these top 5 guys up top, who proactively used home equity as a holistic part of their plan, proactive people thrive and the reactive people survive. Because at the end of the day, it's always better to have more options. Wrapping up here, just in its simplest terms, there's 5 primary benefits of reverse mortgage. All 5 of these don't necessarily apply to every scenario, but pretty much everybody's gonna get at least 2 or 3 of these depending on where you're at. And they are increase your cash flow, pay less taxes, preserve your portfolio, increase your total legacy net worth, or if you have no heirs, just live a better life in retirement. And then finally, protecting your surviving spouse. So summarizing here, our homes are too valuable to just neglect entirely in the retirement planning process and act like I said, just say that our money, it just doesn't exist because I'm never gonna spend it. The best way to incorporate home equity into your retirement plan is with a reverse mortgage. And that's, the academic data backs that up, that's like without question. A HECM or reverse mortgage, it's not a silver bullet, it's not a magic wand, it's not a standalone product, it's not designed to be analyzed in a vacuum. It should be used as part of a holistic financial plan, hopefully with your advisor or your oldest kid or whoever's helping you make financial decisions, just to add value, because people with more options outperform people with less options. I don't believe that there is an ideal prospect per se for a reverse mortgage, although there are certainly some people who would benefit from it more than others. What I do believe is that there's an ideal way to incorporate the money that's in our house for each person, depending on where they're at on the financial spectrum, depending on what their goals are for retirement, depending on their planning horizon, depending on their risk tolerance, right? Anything with money is, the answer at the end of the day is always, well, it depends. That is the true honest answer, so it depends, but what doesn't depend is I want as many options as possible, and that leads me into my last point. Little Army wisdom here to send us out. There's a joke in the Army, which is, how many people can you fit in the back of a Humvee? And my veterans out there will all know, the answer is 1 more. I can always fit 1 more person in the back of the truck. And my question that I've started asking people is, how many streams of income do you want access to in retirement? Because for me, I want 1 more. This QR code takes you, that's all for me. This QR code takes you to, I have 5 published articles that I put out there that goes a little bit more in depth on the concepts I talked about. Here's my contact information, and I don't know how we're doing on time. If there's time, I'll take some questions, or we can keep going. Yes, sir.
Yeah, I'm a financial advisor, and FINRA is the body that regulates the financial advisor fiduciaries. You never want to get a call from them. A couple of financial advisors were sued because they did not present the option of reverse mortgage. And you know, that's not our main product, it's not something we don't offer product, we offer solution. It is a definite solution on our menu of how to help certain clients. Certain clients, it's probably the only thing we can do for them, so they can have a retirement, they can have an income, and a lifestyle that they're accustomed to without running out of money. So I want to applaud Jackson for his, he's taught me a lot about the first mortgage over the last 2 or 3 years, and I really appreciate the presentation today, Jackson.
Thank you, I appreciate that. And not to play devil's advocate against myself, but just to give the whole picture here, there are also stories on the other end of financial advisors being sued for taking all the money out of their house and then going and gambling with it somewhere else. And so, at the end of the day, any product can be abused, but that doesn't mean the tool is bad. It just means, do you trust your financial advisor to give you the most holistic advice? And the example of people being sued for not incorporating home equity, I think is gonna come way more prevalent moving forward over the next 5 to 10 years because of how much money we have stored in home equity and how much, frankly, seniors today on a fixed income are getting crushed by inflation. Yes, sir.
How does a reverse mortgage work?
Yeah, so there's a few ways. All it does, it's just number one, it's just a mortgage. So we don't need to overthink it, it's just a mortgage. But primarily, it allows you to access money, there's only two ways. Equity in our home is just an imaginary number on our balance sheet that makes us feel good, right? Equity is not actually cash. That's the whole point of my first initial thing with the 20 bucks. It's not actually cash. There's only two ways to convert equity into cash. One is to sell your house. The other way is some form of a cash out refinance, of which a reverse mortgage is that. And so it's a way for the bank to lend you money against your house. And with a reverse mortgage, the benefits of it are, number one, it's insured, this product is insured by the FHA, so your access to the line of credit is insured and protected. You get access to more equity as you age, so your line of credit grows over time. And then you can set it up in different ways, which is either just a lump sum, which is probably the least common. You can get monthly payments, which is an option, but slightly less common, or how most people do it is they just set up a line of credit, very similar to a HELOC, but with a little more juice, in that they just have access to funds, and anytime they need money for, my air conditioning broke, I need $10,000, or my grandson's getting married, I wanna send him on a honeymoon, whatever the case may be, hey, I just log into my account, I request 10 grand, 3 business days later it shows up, and there's my money. The benefit of a reverse mortgage, like I said, is if I take that $10,000, I don't have the recurring monthly payment that is associated with the characteristics of a typical mortgage, like a 30-year fixed or a cash out refinance or a HELOC. And so yes, over time you will accrue interest, but what we find is that the way the product is designed, your home appreciation far outpaces your mortgage balance accrual, at least for the first 10 to 15 years. And that may not happen every single year, but over a period of 10 to 15, 20-year retirement, that is the way the numbers work out. Does that answer your question, sir? Does that make a little more sense? Yeah. If you want more clarifying, please come up and talk. I'd love to help you out. Yes, sir.
Real quick, is there an age minimum to qualify for reverse mortgage?
Yeah, so the cutoff is at least one borrower has to be 62. In the state of Texas, both have to be 62. There are proprietary or jumbo reverse mortgages out there. Some of them go down to 55. Currently, Tennessee does not allow those. I'm actually working right now with the Tennessee Mortgage Bankers Association to update Tennessee laws for that very reason, because our law was written in 1993 and it's just a little bit outdated. And now, Davidson, Williamson County, the average home value in Franklin, Brentwood's like 1.2, 1.3 million, and that's the cutoff for a HECM. We won't be able to go up to $2, $4, $5 million, and reverse mortgages go up that high.
And then one more, you mentioned that you don't have to have your current mortgage paid off, but does it have to be 51% or what's the percentage?
Yeah, so that depends on current market factors and the age of the youngest borrower. Right now, if somebody was starting at 62 today, you need about 35% loan amount, 65% equity, roughly. And really the benefit there is, like, let's say you have a $500,000 house and you owe $150 on it, and you got a $1,500 a month payment. We can just refinance to reverse mortgage. The reverse mortgage assumes that loan amount, and that $1,500 a month you can just divert into your investment accounts, into life insurance, pay off other debt, or have fun with it. And just really what you're doing is just changing the asset that's making the payment for you. I'm just letting my home appreciation, my home equity reserves cover the mortgage balance for me so that I can manage my own cash flow. And that's how that works. It's just the principal and interest payment, the taxes, insurance, maintenance costs, those don't go away because they're always there. Tax and insurance are always there.
2 points. Could you explain the non-recourse loan, and I think the biggest question that people have in their mind is, well, my kids are going on my property, what happens? Are they going to lose the property? They're not going to.
Yeah, two good questions. So number one, I mentioned the benefits and protections of the FHA insurance, the primary benefit being the loan is non-recourse. What that means is that you, your state, your heirs will never owe more than the home is worth. So in a very unlikely event that you are ever underwater on your home, and I say that's very unlikely because the program's designed for that to not be the case, you would have to live into your 90s, spend every dollar of equity available to you, and then probably still pass away at a time when there was a market correction for that to be the case. If that's the case, the FHA pays the difference, not you, not your kids. So your estate would be able to walk away, but you, even if you're underwater, you still live in the home as long as you're living, as long as you're paying your taxes and insurance and maintenance costs. As far as the kids, the answer is 99% of the time, kids want nothing to do with the house. They just want the money, so they're gonna sell the house, pay off the mortgage, take what's left, just like if you had a regular mortgage. If they do want the house, just like a mortgage does not change ownership of the home. You never lose ownership of the home. You're just using this as collateral to be able to borrow against the home. And so if they still want the house, what they can do is take the rest of your inheritance that you have, presumably if you have other financial assets, and pay that off, or they just refinance the mortgage into their names as the kids if they want, if it's like a, you know, a family, like my great grandpa built this house in, you know, 1948 kind of thing. But again, those are pretty rare scenarios. 99% of the time, the kids don't want the house, they just want the money.
So in other words, kids don't have to worry about a reverse mortgage taking their inheritance or that kind of thing.
No, and like I said, with that Wade Fowl quote, if you're using reverse mortgages appropriately as part of a holistic strategy, and I have software illustrations that can show this, again, per case basis, so it's not a unilateral thing. But frequently you can leave more money to your kids, even though it's less equity, it's less money out of your house, but your kids don't care if your money's in your right pocket or your left pocket. And so really it's just what's the final number, and if we can have a more efficient retirement by utilizing the leverage of the home, by shrinking our tax silhouette, and by getting larger return in other areas, which is how it should be used as part of a holistic plan. That's why Barry Sachs said it's the mass affluent retirees who have the most to gain from this. Then ultimately you'd be leaving more money to your kids, not less. And that's what a lot of the kids who are nervous about it are more concerned about their inheritance than their parents, which red flag number one. And then number two is like, hey, actually, we could leave you more money by doing this in the long run. So there you go. I think I saw one more hand over here.
Yes. This is a quick one.
All right.
So I take 10 grand out, am I paying income taxes on that?
No, sir. So that's another benefit of it. If your borrowed funds against the line of credit are not taxable income, they are borrowed funds. But then that goes into, you won't pay 6% interest to the bank, you won't pay 10 or 20 or 30% federal income tax to the government. It all just comes down to an opportunity cost thing there. But yeah, it is not taxable income. So good question. That's all for me. Thanks for your time. I'll stand up here at the front if there's any more questions. Ready to talk to you.